All right. Welcome to another episode of the Deal Flow podcast. I'm here again with my illustrious panel. I've got Cody Littlewood, I've got Doug Wilson, I've got Hans Box. We're here once again to chat about housing every single month or quarter. We bring perspectives on the middle market housing space, workforce housing from operators, capital allocators, LPs, and sponsors. So with that, a lot has happened since we last met in January and we ran the last pod. So first things first, I really just want to dive in and ask you guys all, hey, we're recording this March 27th, 2026. It's been a pretty volatile or interesting 60 to 90 days since the beginning of the year. So in January, we covered immigration, demand risk from immigration, inflation and how that's being measured and some of the issues there, and some of the supply math. Since then, we have gone to, I'll say this in quotes, war, because we technically are not in a war. We're in some sort of skirmish, technically speaking, since we never got Congress's approval for that. So we'll just call that a skirmish for now. Rates, the treasury rates are up about 50 basis points versus where we were when we talked last time on the long end. And this week on Monday, we had almost a $2 trillion swing in market value on the equity market due to some volatility related to this skirmish in the Middle East and potential peace or otherwise. That being said, Doug, we're going to start with you. Tell us a little bit, how did your first quarter go with that backdrop? Tell us a little bit about the first quarter. What are your impressions? Maybe how has this year shaped up a little bit differently so far than maybe you expected?
I mean, I guess we're still, macro, obviously stuff's changing every day, every week. I think we still have the opinion that multifamily is a great place, and the skirmish, as you call it, I think is making us more confident and making me more confident. Who knows how long this is going to last? I think that's the big question. Is it going to last? Is it done almost? Or is it a month or 6 months or a year? Obviously, the longer it goes on, the bigger risk that we've got an impact to inflation and thus rates and all the other implications of that. I think if it's over quickly, hopefully everyone's optimistic that it won't have as big of an impact. It seems like it's probably not going to be over right away, but whose guess? Who wants to guess as how long it's going to last? I think what's interesting about it is it's probably good for multifamily in that I guess people see multifamily as a source of stability, or real estate is kind of a safe place. The market doesn't feel safe right now. We're seeing a lot of volatility, as you mentioned, in the market. Multifamily still feels like a safe place to people. So I think we might actually see some more money flow into multifamily as a result. But 10-year treasury's up. It's making it a little bit more expensive for people to buy right now. I think we were just starting to see more sellers and buyers close the gap. Now that might make that a little bit more challenging. So it's a little hard to say exactly how the war or skirmish is going to impact multifamily right now. I still think from a high level, you zoom out from everything that's happening on interest rates, everything that's happening on just the war and the economy and all the fear around that. We are not at the peak of multifamily. The peak of multifamily was 4 years ago. And I think we're, if we stay at the 10,000 foot level and we realize we're not significantly lower pricing today than we were, and we're significantly better place from a supply and all the other things that have happened in multifamily over the last few years, it's a much better place today. And I think we continue to see it that way, regardless of what's happening here in the short term with
Cool. Yeah, no, thanks for that. I guess I would, let's bring it down all the way down to the ground level and kick over to you, Cody. How has Q1 shaped up for you? Given that you're running operations day to day, are you seeing any of the impacts of some of the macro and the volatility at all at the sites?
You say we are. I would say we're in tax rebate season. And so collections are great and leasing activity is picking up.
Right.
And it cost me a lot more to fill up my truck the other day than it has in a long time. And I imagine that our renters are probably feeling that. Yeah, I wouldn't say I'm seeing anything in the macro economy or that's necessarily directly affecting us yet. I think some of those knock-on effects are a little bit longer. And I saw a funny video online, which was just a guy walking around spring break asking what people thought of the war. And they were basically like, I'm thinking about what bikini I'm going to buy in Starbucks and something like that. So this was on on the news the other day. So I don't know how much our folks are paying attention to it or how much it's really affecting them besides what they're feeling at the pump. And that will bleed into other things. And I think generally speaking, some of the sentiment that I'm hearing from folks is that everyone's stretched, and so is concession and deal shopping. So I think that's a little bit my worry is as fuel prices go up, so does several other big buckets of things that cost money to transport, especially stuff like food. And so I think that would be my bigger worry right now is, what we're going to start seeing, are we not going to start to see some concession relief? I think that there's a multifamily operator, I want to say it was MAA or Camden, one of those two, that basically said, as supply dwindles and concessions trail off, that's a 15 to 20% boost in revenue without touching rents, right? Just from the fact that concessions burn off, you get an extra month of rent. And so do we not see that if people are continually stretched and everyone's deal shopping, even if supply dwindles, if consumer behavior is to be shopping for deals and your consumer confidence is low, household formation is then low. So I think that's probably the big worry is those later tail effects. But it's so recent that I don't think it's really showing up in any of our data right.
One thing this makes me think of a little bit, I remember Hans, you and me talking back in like 2020, we're like, hey, is inflation coming? Like we think there could be inflation coming. At that time, I think there was a lot of government stimulus and that was our fear. And at the time we thought, well, it should be a net positive probably if inflation from all this, does happen. And I think looking back at it now, I'm curious what you guys think, but looking back on it now, I think we did see an impact to expenses, our wage growth happened. But I think overall, the real thing that's impacted multifamily the most in the last few years is really the supply side of it. And I think that was sort of what we were thinking at the time is, well, inflation may happen, but this is really a supply demand question. It's not an inflation question. You just reminded me, I'm having flashbacks to that time where I was like, hey, inflation might be coming. How should I prepare for it? And I think at that, if I learned anything from that point, it was don't worry so much about inflation, worry more about supply and demand. And I think, today, I think if we look at supply and demand, it's actually looking pretty good for multifamily. There's not a lot of new supply coming. Now, the question is more on the demand side and how does AI impact that and other things. But I think from the supply going down, at least that part of the equation is looking really good. And even if inflation does tick up from oil prices being high a little bit longer from the war dragging out, it doesn't change maybe the bigger lever, which might be, supply and demand in this case.
Yeah, we're definitely going to get into some AI and certainly I think there's some dynamics occurring in the demand side that we touched on last session, but we'll cover those in a little bit. I want to go over to Hans and I want to hear from you related to maybe sentiment, although like what Cody said, on the ground, the residents may not be feeling this too much yet, maybe a little bit at the pump, maybe not so much anywhere else. And maybe they're not spending a lot of time watching the news cycle. It's probably for their best for their mental health anyway. And
for all of our mental health.
For all mental health, I think that's right. Yeah. But on the LP side, I'm sure when people are thinking about allocating dollars to opportunities that are long-term and illiquid in nature, they're probably looking at that. What does that outlook look like? Has it changed at all? Your conversations this quarter, have those changed at all? How is sentiment in the investor community, in your view? And has that changed at all, since the last, the fourth quarter of last year to now, given everything that's happened?
I would say it probably has gotten maybe slightly even worse in terms of investors wanting to put out capital for deals right now because of the fact that, investors, whether they're sophisticated or new, really the holdback for investors is always uncertainty. And the very definition of the environment we're in is uncertainty right now with the war and or whatever it is that's going on over there with AI, with our economy, with the inflation that you guys talked about. Are they going to raise rates or, we're going to get a new Fed chair and all that together adds up to uncertainty. And so I will say that, our experience, our direct experience over the last quarter is that investors are definitely more hesitant to put money into investments, and especially those investments that are illiquid. Liquidity is tends to be, is always king, but right now it feels even more so in the investors' side.
Yeah, no, that makes a lot of sense. And yeah, I think the fog of war, right? They say is it's difficult to see what through that fog of war by definition. I think one other thing to just note about oil prices, I don't know if I might be a little bit off on the numbers here, but I think from a budget perspective, at least in the U.S., gas prices as it relates to actually filling up your tank, you know, is only a 3 or 4% line item in a household budget. Now, it is an input to all these other things, and that drives costs. But if you were to look back at 15 years ago, um, you know, uh, peak oil prices at a 145 for Brent crude or 110, 200, like those are those dollars are a lot less valuable today. And so it's not like we're seeing $500 barrels of oil and it's taking $15. That same 110, $120 barrel of oil, you were paying more at the pump 15 years ago than you're paying today when oil was that high. So I think there's something to be said about that. Although in
Well,
California, I guess people are paying like
I think
$10.
part of it's also just perception, right? When people see, have been used to relatively lower gas prices, and then
Right.
they start seeing that go up. And then along with other pricing, you see gas prices everywhere, right? So people notice that, right? And then you add that on top of some news station trying to find the most expensive station on some corner and in LA to show, oh, gas is $8 a gallon for the premium. It's a little bit of that too.
Yeah. Yeah. Yeah.
Yeah,
Absolutely.
I would say generally consumer sentiment, household formation are not as much data driven as they are vibes driven.
Right.
And the same with LPs for that matter, right? Something that I thought was kind of interesting the other day, as far as like LP allocations, that we may see some tailwinds in our field, and that everyone kind of knows like the big run up in 2021, peak pricing, crazy cap rates, market friendly, tons of capital in the system, ZERP era policies, then big crash with like all this new supply and the Fed raising rates and everything else. And a lot of the money that was chasing CRE started chasing private credit. And private credit has been a darling for a long time. And I keep hearing, I've heard for a number of years, right? Why would I try to get 15% on common equity when I can go get 12% in, and be a credit holder, right? Or a bond holder. And now you're seeing a bunch of those blowups, even in the kind of like blue chip space, people that thought, who's it? Bose Weinstein made the tender offer for Blue Owl shares at 30% below because they're gating, I think several private credit funds and BDCs have started gating exits, and their private BDCs have started gating exits, right? And it's kind of funny. It's never data driven, right? Always. I think it's kind of like vibe driven. And so that may be something that we see as a bit of a tailwind on the CRE. And I think there's in the CRE space, I think I read the Wall Street Journal comment on it before, where with all the nervousness around private credit, and it feels like that is kind of like on the edge of maybe a blow up or certainly a reset. Some of that money, money's always chasing the next shiny thing, right? But it may be moving back into CRE for that, like, for that more stable hard asset based return that they were chasing in private credit for a while.
Yeah. I think I think we have seen like high yield and like below investment grade credit spreads widen a year to date. And so I think Doug, you mentioned this, or everyone's mentioned liquidity is king, right? And so when people are trying to raise cash, where are they going to go, right? To raise cash. And so, private credit can be a great opportunity to raise cash, but if people are, you can only liquidate 5% a quarter, then that, creates some limits around what people can do to raise cash in that space, but they don't necessarily want to sell equities so I think it's an interesting situation in the alternatives where people are trying to figure out where to raise cash, and then it's causing this sort of like snowball effect where spreads are widening, people are gating their outflows, and then there's the news cycle around, oh, all of these private credit deals are going to blow up. But private credit essentially funds middle market firms across the country, right? These are, the everyday firms that you see that are making $3 to $100 million a year in EBITDA. They are a bellwether and kind of the canary in the coal mine. If they start going, then, it's something we need to be watching on the CRE side as well, because that's a sign of a economy that might be, turning over. But as of right now, I don't see any signs of that. I think it's more of like what Cody, you've been saying, it's more of a perception and a news cycle issue than it is like actual fundamentals that these companies deteriorating. And maybe
Yeah,
they're
and
a little
what's
over leveraged, but I don't think the fundamentals are necessarily broken there.
and
Hans, you would,
is the question whether the companies themselves aren't making debt payments because of operational issues, or is it because of bad lending standards and underwriting standards?
yeah, yeah,
Or
yeah.
is it all fine and everyone's just scared that AI is going to kill software and it's going to, drive these companies under? Maybe there's
Yeah.
no problem at all. Yeah.
Well, yeah, I mean, maybe they shouldn't have been giving 7 or 8 turns of leverage to software companies because they probably thought reoccurring revenue, why not? But not all companies should have a lot of based on, cyclicality and stuff. So yeah, that's a good point. We'll see. What do you guys, Cody, you have I think a decent handle on what's going on in the software and the SaaS world. And I know that certainly multiples have come in. Do you feel like there's a pending crisis there?
I mean, people pay for multiples based on a discounted cash flow, right? And so as you start to discount the probability that those cash flows will exist in the future, I think you're going to see multiples come in, right? Like I think real estate, I think it's much easier to justify. High multiples, right? A 5 cap is a 20x multiple. But really, if you look at it, right, like, okay, 20 years in the future, is this building still going to exist? Are those cash flows still going to exist? You have relatively high certainty, right? But with, I think, software, if you're paying 20x, there's got to be some growth baked into it, because I think it's very hard to assume that those cash flows are going to be there, that far into the future in a world that is moving so fast. And I think everyone's seeing how fast it's moving, especially right now, where you have agents developing agents kind of thing, right? Like a code developing code, and that rate of change. And I think that certainty is certainly moving out. And so I think it's justified. I think that it was always a little wild to pay some of the multiples for certain bits of software. The hyperscalers may have a decently defensible moat, but I think what makes the technology space so interesting, I think it's very rare. I think if you look at like the leaders of the S&P 500 every decade or something, I think I can't remember. There's some statistic I heard, but essentially look every decade, and there's maybe only 50% of the same companies in the, I don't know, in the top X, right? And if you look every 20 years, it goes down even further, right? The world moves much faster than we kind of bake into our assumptions that it will. And something that feels very certain today is probably not logically priced as much as it's, going back to the logic versus vibes, right? As much as it's vibe priced. So I don't know. I think that the multiples coming in is reasonably justified. And I think the world's just changing way too fast to be able to underwrite, that far into the future.
Well, let's turn our attention then, with all of that positivity and uncertainty now that we've discussed. Maybe talk a little bit about, given that uncertainty, how do we best try to do our best? We do have to try to do some projecting when we do budgets, when we do projections long term for deals, and when we think about what our outlook is for and the world that we live in. So, switching to kind of rates a little bit. The Fed is now signaling 1 cut in 2026 versus however many they had been previously doing. Or at least I think when we started the year, there was an expectation of like 2 or 3. And then if you were to go back, to the middle of last year, I think there was like 4 or 5 cuts expected for this year. Goldman is still saying maybe 2 if this conflict resolves quickly. I think it's silly that you wouldn't cut rates in the face of a war. I don't see why those things are connected exactly, but everyone seems to think they are. How is that change the calculus at all? And I'll give this to, Hans or Doug, you know, either one of you want to comment on, has, the fact that we're now projecting less cuts, is that changing your view near term or medium term around cash flow expectations in real estate, deal volumes, that sort of thing?
I mean, it doesn't really impact us right now, right? Almost all of the properties we have are fixed rate debt, so they're not impacted by movement in the short term or the long term rate for that matter. I think the question, I don't know how anyone makes a prediction on interest rate cuts right now, because that would mean that you think that you can predict when the war is going to end. And maybe people think they know that. But I mean, I think that people are tying them together, because if oil prices stay up for too long, energy affects everything. And this could be a structural problem that goes and impacts the entire economy. And it could be another drive up in inflation, just like we saw back in the COVID times. So if that happens, obviously we're going to see the Fed react on the short side. And then, if there's long-term inflation, we're probably going to see the longer term rate go up as well. And if those things happen, I think it just means there's going to be less transactions happening in the market right now, and we'll probably end up holding properties longer. I mean, it will impact people that are refinancing, and it impacts construction. I think, if short-term rates go up, I think we're going to see a big hit on construction projects, which we're already struggling. So I think, that just makes the supply picture better for those of us that are buying existing or own existing assets. I've been sitting here thinking, all right, well, if short-term rates go down and long-term rates follow because inflation's under control, then we may see a shorter window of time to buy properties before people start piling in. Maybe this means we actually have a little bit longer to buy some properties before, the crowd starts jumping in. But like we said earlier in the call, I think real estate is considered a relatively safe haven. And as Cody mentioned, if people are moving out of private credit and equities and looking for someplace else to put money, that could also increase demand on our side. So which could push cap rates down. So there's a lot of opposing factors and changes happening, and it's hard to really say. I think the good news is anything we own and right now, or anything that, like, we're buying one now with you guys that has a loan assumption, anything with fixed rate debt, I think is not impacted in any way on the rate side. And I think it's probably good news for us overall good news for us as owners if construction continues to dwindle. I think that makes housing, that probably will drive higher rent growth. And the fact, if rates stay higher longer, I think we're looking at more expensive mortgages, and that makes home ownership more difficult. And that's also good for multifamily. So all that to say, I mean, there's just so many different pieces moving, some of them positive, some of them negative. Overall, I don't think it changes our overall view on now being good for multifamily.
Yeah, most of that seemed like the negatives or positives. Like everything that was a negative from maybe like a policy or like a general economy perspective. But those negatives, I think long term for people who are really looking to buy assets and hold them long term, it seemed like all positives, right? If you have higher, longer term inflation, that flows through rents, that leads to higher rent growth. You suppress construction, you've got less supply to compete with,
Less affordable housing.
Yeah, less affordable. I mean, these are not like, we're not wishing against, having more affordable housing, but the chips are where they are. And I think a lot of that tends to be supportive of existing assets. I don't know, Hans, if you have anything that you want to say, I think related to, given there's all these conflicting macro, like all these conflicting scenarios, right? It's a little bit harder. And maybe that points back to the uncertainty point that you made earlier. Anything more to add there?
No, I mean, pretty much agree with what Doug said, and it's the uncertainty is causing capital to hold. At some point, in terms of the with the debt structures, we're seeing more transactions and more opportunities to possibly buy good assets right now. So as those start coming across our desks, and that's mainly because of refinancing issues and debt issues, not anything else other than that. Everything that's been kicked down the road is finally, I think, kind of coming to a head now. And so we are seeing more transactions, and so LPs, I think, just by sheer force and seeing more volume of deals, may start loosening up a bit to invest once they see that these deals they keep getting bombarded with great deal opportunities. There may be, some softening with investors, but I think as long as we're at war or whatever, and that we have this uncertainty, I think it's going to be relatively more difficult than the last few years to raise capital.
Mm-hmm. Yeah.
I would add one thing too. I think it's challenging for existing investors, which is, and we've heard this from many of our investors, even the last couple of weeks, which is we bought a bunch of real estate over the last 5 years or even longer, and now it's not exiting. Capital's not recycling because, multifamily prices are down. Now's a great time to buy, but now's not a great time to sell. And so I think one of the challenges of existing investors in real estate and multifamily is, they maybe tapped their available equity and they're waiting for some stuff to exit. Now that's an opportunity for new people coming into multifamily right now that might have other sources of liquidity. But I think it is one of the challenges that many of our LPs are having.
Yeah. The liquidity availability, right? It goes back to that. And yeah, people are fully allocated and they're not going to put new money. They're just recycling and rolling that forward. And but this year, as I think it was stated, we're expecting to see more refinancing activity. But with rates staying elevated, I think, does that create another small leg down in pricing or just create more supply opportunity, right? Where it's like, hey, these deals are not going to get refinanced, and they're just going to have to sell. And I think that, represents an opportunity. But yeah, maybe we have a longer window to acquire in this cycle, which would be great and on the buy side. So, I think additionally, I know we've talked previously about jobs and wages and, definitely job growth has been anemic and in fact pretty significantly negative in February. And nominal wage growth, I think, is almost at 4%, which sounds pretty great as long as oil prices do ultimately not hurt people's wallets too much. I guess, Cody, you sort of hit this already, but on the ground, are you seeing any change to the quality of tenants, or are you starting to see that like doubling up behavior where people are saying, hey, it's time to maybe try to tighten the belt a little bit by maybe they're going to a smaller unit type, or maybe they want a different type of product. Maybe they're not willing to pay up as much for premium finishes. You seeing any kind of behavior change at all that we should be thinking about?
It certainly feels like it. Yeah, it certainly feels like that. It feels like people are stretched and they're more willing to, they want a clean, good, they want a clean, good, safe unit in a nice area, and I don't think that I'm really seeing many people, we're not seeing a lot of willingness to pay up. Right. And so I think, the renovations that we're focusing on right now are not, top dollar like renovations. Are kind of, they're really like middle of the road, handle deferred maintenance. Yeah, people want to live in a place that the AC is working, that maintenance items are taken care of quickly, that there's no major issues. We don't want to have major issues down the road. So really deferred maintenance, nice units that have all the essentials in them, that look decent, are clean, et cetera, but not, we're not really seeing a lot of demand for trying to pay for granite countertops. At the end of the day, certainly not in our markets. I think, but overall, I would say that's been a sentiment that has been in place for a year ish, and I just haven't seen it really let up. So I think in general, that's our focus, is not trying to be, we definitely don't want to be top of market, right? You do not want to be the person that needs to hit top of market rents right now.
Mm-hmm. Yeah. It felt like there's a time every cycle where people are willing to sign a new lease on the basis of a really cool looking apartment, right? And that's almost like a marketing tool. But then, everyone lives in a house. A place. And by the end of the first month, how much does that stuff matter really? It's really, does everything work? Does everything, I think, we're in a different environment, and that makes more sense if people wanted, that they would be, I think, going for a different type of product. And so I think we provide the right type of product to that type of, workforce housing consumer. I guess across the rest of your guys' book, I know Hans and Doug, you guys have, assets that you in other asset classes that may be more in like mobile home parks or otherwise. Are you seeing any interesting information about, those types of tenants, or those, are you seeing the same types of behaviors there, or anything else because I think there's always great information to gather from what's happening in the new construction or that mobile home park space, or what's happening in other areas around the country, because you're also in different geographies. Like are you hearing different things in other places I guess what I'm saying.
Yeah. Well, I mean, I'll take you through two things that came to mind. A couple of things came to mind. Self storage facility that we're in lease up mode is actually leasing up relatively well, considering all the news we've been talking about. It's I don't know the amount of units per month, but we are essentially tracking pro forma in terms of lease up velocity. Granted, as in any lease up, we're giving the units away pretty cheaply, and that's just what you do in self storage. But it is leasing up and tracking pro forma, which is good news. And this is a deal in Georgia, south of Atlanta. Mobile home park space. We're turning a property around right now that was in the 60s in occupancy, and we are projecting to be in the 90s within a span of a couple months, 2 or 3 months. Correct me if I'm wrong, Doug. We have like 14 open leases, and so it's leasing quite easily and well. People are looking for affordable housing. And then anecdotally, this isn't our deal, but I know a guy here in Austin, and obviously I live in here in Austin, so track the market somewhat. And he just brought a brand new property online in northeast area of Austin near Samsung, which has a huge presence here. And I don't remember, but I think it's something like 33 leases a month average or something. That, I mean, he basically is way ahead of pro forma. And everyone's heard all this negative talk about Austin and how occupancy's down. Well, has been down or is down comparatively, but that's because of supply that we've touched on here earlier. It had nothing to do with the actual ability of the economy to absorb units or jobs or companies moving here, people moving here. It had everything to do with supply. We just, as Texas does, developers develop, and when there was cheap money, they built, and that's just what happens in Texas. So he's way ahead of his pro forma in terms of lease up velocity in his new deal here in Austin. Doug and I heard this interesting stat from him that I didn't know this, but did you know that the second most affordable city for rentals in the nation, at bigger cities, when looking at rent to income ratios, is Austin, Texas, which is shocking to me because it's always been more of a coastal like market in terms of costs and the cost of dirt and the rents here. I mean, there's a deal that's going up in downtown Austin right now it's going to be north of $5 a foot in rents. And I was like, in Austin, it just seems nuts for Texas, right? We're going to live in LA or New York. But it's happening. Point being is that all the supply has really made Austin very affordable, not counting the downtown core, but in terms of suburban type deals. So anyway, that's some of the info that I've gleaned over the last quarter on this.
Yeah. I think that's I think I think we have in the doc here that Austin's seen 10 quarters of rent decline. But that only goes on so far. Eventually you get to a price that people, is very compelling, right? And like you said, people are continuing to move to Austin and people love the vibes there. If I was to take Cody's term there on vibes. And so I think it's a great opportunity for people to take advantage of, that extra supply. And I was listening to the Rent Roll podcast, which I think is a great information source for anyone who's listening. Jay, who's the host of that, was talking about there was a study done by Hughes Charitable Trust or something. I don't remember the exact, maybe saying that name wrong, regarding that the best antidote for high rents is more supply. And I think this is something we all instinctively understand, but for some reason, the government, gets in sort of the way of us being able to put out more supply. But, if you look at what happened in Austin, enormous amounts of supply has brought down rents. And so I think maybe those folks in LA and New York City should take restrictions are not the best way. And maybe you need to let people build and take some pressure off that supply demand equation. That one other thing that I noticed here is that the renewal rates are the highest they've been. And I think that points, Cody, to your comments. I think the note that I have here is that record renewal rates at 57% It means that even in areas where you have asking rents falling, if you have renewals going up and asking rents going down, maybe you're not in such terrible shape. I think you mentioned this a little bit earlier about effective rents and just burning off concessions. Are you seeing similar types of, high renewal rates where people are just, they want to stick where they are, or, does that change at all over time? What are the thoughts there?
Yeah, I would say, I mean, in general, renewal rates are quite good. We are hitting leasing season, and so they generally dip a little bit as people are more willing to move during these times. But yeah, I mean, I think there's a cost of moving, right? And there's friction that's added to it. And in times of uncertainty, people don't move. And so that may also be it, right? But certainly, I think we're focusing a lot on renewals right now. And even, we have a property where we are renovating and in Panama City. And surprisingly, one of the biggest areas that we keep seeing, the biggest areas of new people taking the new rents are current residents that are like, I'll pay that. You're going to redo my unit and do all these things. Like, I'll pay that. And so we call them, transfers. And that's been kind of really interesting in general. So I think just during times of uncertainty, people are maybe a little bit less interested in moving. And yeah, I'll be interested to see if that continues to be the case, because also it seems odd to me that there would be high renewal percentages, but also high concessions. Usually concessions drive switching, right? Because yeah, I mean, especially in our economic segments, anybody that can get can get a month, 2 months off of rent, that's a big chunk of money for them.
But I think that there is a huge financial cost and just burden, like emotionally, of moving, right? The process of finding a new place. I mean, I think you
I
just
agree. I just don't sometimes, yeah, people don't make decisions
right. Like,
based on
ooh,
the same amount of
great,
logic
new
that we do.
TV. I'll take the TV. Let's move across across town.
It's
Yeah.
about
That
it's about
$200
vibing.
TV. What do you say?
It's
On the
about
vibe?
vibe.
Yeah, great
Yeah,
vibe.
bad vibes.
I
Bad
think we have
vibes.
I think what we need to do is change all the names of our properties to the Vibe at
The
City.
vibe.
That's it. That's the name. That's the whole thing. So I think, one thing that we did touch on, and this whole, immigration has obviously gone, net migration, has basically gone to zero. And so now we're 2, 3, 4 months into that. Are you guys seeing, now we're still seeing people moving around the country, but basically nobody's coming in, on a relative basis. Certainly it was millions before. So, and we see that in the jobs numbers. We see that the BLS has revised how they're calculating employment to adjust for the fact that we no longer have immigration, at least right now during this administration. Have you guys been hearing anything about, is that restricting construction worker availability? Is that driving up the cost of construction labor? I know you guys, I think Hans, you had mentioned about a new deal. I assume, obviously the construction's completed on that one, but are you hearing about, the availability of construction workers and how that's affecting the ability for operators to get new supply delivered today? Anybody hearing anything about that?
I mean, Doug, we're not really hearing that in our two development deals. We haven't come across any issues with delays because of labor yet, but these deals just kicked off, and these are really nice deals in Austin and Denver. So I don't know whether or not it would be the same demographic that would, be working on these deals that causing issues at this point. I'm not, but we have not heard anything.
Yeah. Yeah. We'll keep an eye on that, because I mean, they're like, what in these millions of people, what were they doing? And now they're not here. So, it's like, they got to show up somewhere, if it's not in food service or hospitality or construction, where what's going on?
Well, this is purely speculative. As you are seeing development dry up, certainly construction employment has to dry up, or at least, from somewhere. You're not really seeing it in the numbers. New starts are like down massively, but you're not seeing a bunch of layoffs in the construction industry. And maybe that was just because, I don't know, this is purely speculation, but most of those numbers would really show up with legal employees, not with folks that are being employed illegally, I would have to think.
Yeah. Yeah.
So I wonder if it's kind of like if it ends up being a wash, right? Construction should be down, but the legal employment of construction isn't down, because most of those job losses were absorbed through, through, net out migration, so to speak. And I don't know that's true, but you would think you'd be seeing it show up more in the numbers in construction job losses. And yes, I think construction's tighter now. You're seeing a lot less hiring. We're getting calls back from GCs. Not everyone's drowning in work, so it's definitely softer out there, but you're not seeing like massive job loss yet. And maybe that's just because the job loss came from folks deciding or, having it decided for them that they'd be leaving. So I don't know if that's the case, but rings, there might be something to it.
Yeah, maybe. And there was like a time when people were like, they had like 3 years, 4 years of backlog, right? They were booked out so far that, even a reduction in demand just means that they're not as far out, booked, right? They may just be booked for this year versus booked through 2030. And so when they're bidding out jobs, they're not as aggressive and saying, well, I'll do this job if you pay me twice what it's worth, but otherwise I'm booked, So I think that all bodes well, hopefully for, again, better pricing for some of these things and certainly renovations when we need them or jobs that we need. So we're coming close to the end here, and I would be remiss if we did not speak about the elephant in the room, which of course is artificial intelligence. So we can't go a single day or a single podcast without hearing about it. And who even knows, maybe we are all just avatars of ourselves and we're all just sitting on the beach right now. And our avatars are just chatting with each other. But until that reality becomes true, because they are in fact, Doug's proving that he is in fact a human. He's moving around.
I dropped something. I did not do that.
Right. Well, if you were a robot, you wouldn't have dropped anything. So, that's a telltale sign of a human for sure. So a couple things that I saw, and then I'll kind of kick it around to get, impressions. Entrada, excuse me, not Intera, Entrada, a couple days ago launched the industry's first agentic property management system. I mean, this is they're saying that this is the first, this is a press release. So just take it with a grain of salt. With 100+ embedded AI agents across all of these core domains: leasing, maintenance, accounting, payments, and ops. Now, Entrada is a competitor to Yardi. They're a system of record and a CRM. So they have the benefit of kind of sitting across most of the core systems there. And they branded that autonomous property management. McKinsey in this month said that agentic AI systems could unlock $500 billion in annual value across real estate and construction. I wonder if they used AI to come up with that number. McKinsey, we'll see. And then it says, I see 99% of multifamily operators are implementing or planning on implementing. It's sort of cheating by asking the question that way, that are you planning on implementing AI? And 77% report lower operating expenses from doing so, and 85% report higher lead to lease conversion rates. So people seem to be using AI in some capacity, and they're definitely starting to see some, maybe some results, which I think we've been waiting for a little bit. So that being said, I'm going to give it over to Cody, because Cody is our resident software development extraordinaire technologist. And so before I give it to Hans and Doug, I'll give it to you, Cody. And what are you seeing? How are you on the ground? Executing and implementing AI? Is it valuable? Is it smoke? When is it ready for big time production? And what are maybe some of the challenges that we're not hearing so much about in the news?
I would say it's very real. And I would say that anybody that's experienced has experienced it in their workflows and is pushing it into their workflows in a very purposeful way will tell you that it is incredibly valuable. One of the things that we're seeing is like the most valuable employees, the employees that will always have a job with us probably, are the employees that are adopting it the fastest. Even though, you kind of think like, I think people think, oh God, if I start using this tool, I'm going to make myself irrelevant and, worry about job security. But really it's just superpowered the top employees already. And I would say it's fully ready for production. It's taken the cost of developing and reporting and things that normally it's made our ability to view data. I think one of the biggest places where we've seen a huge amount of gains is it's made the ability for us to connect disparate systems across our organization and view data in the way that we think about data affordable for us as a kind of, what would you call us, a smaller firm, right? And I think that normally these types of custom integrations would be, these types of custom integrations and dashboards, and to really see data fully in the way that like makes the most sense to us, instead of just whatever the 80-20 rule is for the existing software developed, or, that's been developed for our space. It would take millions of dollars and huge teams, and just would be unattainable for a small firm like ours. And so I think it's just been an incredible unlock, and we're giving it to all of our employees and really pushing them to maximize their use of it. I'm really bullish on the future in this space. At the same time, I think there's there is a decent amount of nervousness. I think I would be it would be really scary to be an entry level employee right now coming out of school, and not to talk our book, but I think that I'm really happy the vast majority of our folks are, nurses and medical techs and mechanics and, construction workers. I think that, our workforce housing feels like, at least for now, until robotics catches up to AI, a lot safer than maybe some of the knowledge work does. However, I think people felt that way about, class B versus class A. And, what we saw was was a bunch of supply in the class A, still created some softness in class B, maybe not as much, but it did create it, because there are knock-on effects. So I don't want to say that it wouldn't have an effect, right? Because I think overall employment across the nation has knock-on effects. But yeah, it's both incredibly exciting and also I think a little bit frightening, because I think the transition from the world we've known before to the new world, it'll never be smooth, right? And I think humans will always adapt and find new and more valuable ways to spend their time and become more productive, just as they did with the horse and buggy in the car. But there still will be, but there still will be some pain in the meantime.
Sure. Yeah. No, there was this film in the 90s, I feel like, by James Cameron about the Terminators and such. It's, it's probably not the base case for you, Cody, is that I'm waiting for I would love a Terminator to come in, reprogram that baby to just do my dishes, right? Do my dishes, do my laundry. If there's someone, like that I guess technically this is being recorded, but I have a woodpecker that every morning, top of the house, I have this metal thing that's on top of the fireplace, all the way on top. It's like waking me up. So I wouldn't mind a little Terminator action going on here. Of course, all birds are protected in the state of Colorado.
Especially Boulder. Yeah.
Especially in Boulder. So forget that. For Taylor, I didn't say that. We'll cut that out. But I guess that Cody, more so on the challenges, and then I'll hit both of you, Doug and Hans, on this. I really want to get your opinions about what's going to happen with the white collar professionals. Cody, from a software perspective, I think people think that maybe AI is magic, right? It appears like magic, but there are some downfalls of people kind of running away with themselves with AI a little bit. And I don't know if there's anything you could leave people with that maybe how can they best execute, AI in their business, right? In a usable way that's production based, and not just like have people going around and just burning through tokens on nonsense that never actually makes it to application. Any interesting or thoughts there?
I would say that it's very tempting to do everything, and that now more than ever, good judgment is important. And so I would say ensure that ensure that it's making a meaningful difference in your business. And at the end of the day, it's just a tool to accomplish a specific goal. So you want to make sure it's accomplishing a goal, right? But yeah, at the end of the day, there has to be a real business objective that's being accomplished, and it can't just be. It is really fun to build with, and you could build things all day, but knowing what to build and having that judgment and that taste of where to spend time, I think is really important. Understanding the difference between an initial greenfield application, which seems really easy to build, and then getting that to a production level application can also be really hard. And so there are some great principles that you can put into place around how to architect the things that you're building and make sure that you don't see a lot of drift. But I think being really conscious about how you build things, and and then just I think you have to push things into production as much as possible. I think some easy wins are to use Claude Cowork. And I think that's a really easy win that everyone can unlock tomorrow. Anytime you got to look at an Excel file and you were going to run manual calculations or a manual analysis on something, anytime you were going to work on, drafting a memo or a PDF or something, anytime you were, if you have reporting that you want to do on an automated basis instead of scheduled tasks with Cowork, that can be really powerful. But I would say, the limitation is your imagination and your judgment. And so just start working with it and asking it how to do things. You don't Google to do things, right? Just work within it and try to work on it. Use it to accomplish every task, and you'll really, you'll become more native, and you'll start to see the true power, and that's really where the light bulb moment will happen. When the light bulb moment happens, it'll unlock a lot of value in your business.
Doug, I think
I just find this so.
Something I feel.
No, I just find this whole thing. I mean, I'm enthralled with AI, and I've got agents running next to me right now, and I'm like, don't look, stop looking at your agents, because they're constantly running. But I think the big question is, what does it do to jobs? And it's really, I think I've heard so many opinions on this. The parallel that I think of a little bit here, and Cody, I'm curious what you, coming from development world as well. I used to be in the hardware development world. But the parallel that I think of here is when people started going to India and to other places to find really cheap labor. And so, back in the day when we built, these big chips that cost $100 million to build or whatever, we would go with teams in India where we could get an engineer for, $5K a year instead of $100K a year. This is, 15 years ago. My pricing is a little bit out of date now. But the point was, you got this really inexpensive labor that was very good, in another location. And I think if I fast forward to today, we were sitting around 1 year ago, almost not even a year ago, 9 months ago, and talking about where are we going to hire our next help to go do a bunch of manual things. And we were looking at, we set up work descriptions for virtual assistants, and we started thinking about which activities were we going to try to get off of our plate so someone else could do them. And now fast forward 9 months later, and there's not even a question. Now it's like, all right, well, so how is AI going to do this for us? And I think, now what I'm curious of is, does this displace jobs, or how does it displace jobs? Because on our side, it's not actually displace any jobs. It's actually just letting us do things we couldn't do before. And I think that's what Cody's experience is too. He couldn't have all this integration before in an affordable way. So he probably wasn't even going to try to do it, or at least not to the level that he's doing it now. And I even look at the stuff that I'm running here that I have running this morning. I'm doing levels of analysis on things that I couldn't do before. I just didn't have an economical way to do it. It's not necessarily reducing the work that we need to do. It's actually creating more work for us, because it's allowing us to think about all these things in ways that we couldn't before, and have all this analysis that we couldn't before, and do all this level of reporting that we couldn't do before. So I think in the short term, it almost seems clear to me that it's going to slow down hiring substantially, because people have these teams and they're going to start using them more efficiently initially, and probably not growing their teams. It's probably going to, I would think, slow down job growth a little bit in the coming. Now, is it going to crater job growth? One of the opinions I've heard is, oh, well, and we've even thought ourselves, do we even need to pay software licenses anymore? We just have Claude build it for us. But I think to Cody's message, or his point a minute ago, there's a real art to, what product do I need? What features does it need to have? How do I test it? How do I make sure it's production quality? And this isn't our job. I don't want to be doing, we've had the debate around accounting. QuickBooks annoys the crap out of me. It's expensive, and I don't think it's very good. And so could we build an accounting software that would do the same thing? Yes, but that's not my core business. And I think that's what's going to happen for a lot of people. They're going to be like, well, could I use Claude to build this software tool for me? Yes, but it's not my core business, and it's a distraction. And I'm now having people try to spec it out and test it and make it production worthy. So I will say my personal opinion is, I don't think all these different software companies disappear. I just think suddenly they get access to a bunch of really cheap, fast labor like we did back in the day when people started farming stuff out abroad. And that didn't cause a job collapse either. In fact, we've always had a job shortage. It's we've never had enough high-tech workers to do the work that we want to do. Now we're just going to have a whole bigger army of people out there that can do these jobs fast and efficiently. I don't know. If I look at my crystal ball, I think a lot of these software companies continue to exist. I think they've become a lot more profitable, most likely in the short term. And then competition is going to maybe we see price reductions because now people can do things so much more efficiently. Prices start to come down a little bit. I don't know. But I don't necessarily think we're going to see a job collapse more than I am that maybe there's going to be a job slowdown because people become more efficient. I think there's this thought that AI is out there now and things are going to collapse. I think a lot of people don't have time to play with AI right now. They've got a day job. They're trying to do their day job. They're trying to squeeze in a little bit of learning in parallel. Or if they're like me, they're working at night and they're upsetting their spouse because they're so addicted to AI. All they want to do is be on their computer. And my wife is like, you got to get off. You got to stop working on AI at night. And I'm like, well, but I have other things to do during the day and I don't have time to mess with AI. And I think that's going to be a problem. I think still a small number of people are actually replacing their jobs with AI right now because it's a struggle. And that's going to change. They're going to have to because they're not going to be relevant anymore if they don't have AI experience. But I think that may take some time as well. So anyway, my 2 cents, I think AI is amazing. I can't get enough of it. I guess one other thing that I think is going to be an issue at some point, and Cody, you may know better, and many people out there would know better than I would, but as people start to pile into this and the fact that data centers are taking so long to build because of power is taking so long to build, I wonder when we're going to start hitting real limits on processing capacity. I don't know when it is, but these things just take time, and I think the power is the thing that takes the longest. Putting a data center up and putting chips in it doesn't take as long, but trying to get a new power source, that takes time. So it's going to be interesting to see how data limits affect this whole thing too. All right. Yeah. Processing.
I want to give, we're almost coming out against time. I want to give Hans, I want to give you the final word on anything around AI, anything else that you're seeing. I think especially around the engineer, the entry level, I just don't know what entry level analysts and, that are checking for periods and fonts and what entry level engineers and auditors and all these people who are doing these highly skilled, but now very much potentially computerized tasks are going to do. But Hans, final thoughts on AI, and then we'll wrap it up.
Yeah, so I'm not an AI or computer nerd like Doug and Cody. In fact, I use it, but I'm
But
still.
he has fantastic hair. But I mean, the hair, it's fantastic. So I mean, there we go.
So it's cool. Yeah, it's going to be bigger than the internet. I 100% agree with everything they said. I'm kind of taking a step back and look at a more macro thing. Jobs are always, we're going to lose jobs, and it's going to be different this time. Personally, I don't think it's going to be different this time. That's what, it's different, yes, but is it going to be different over the long haul in terms of destroying jobs? Over the history of the world, any new technology in general has created more jobs. It doesn't destroy jobs. New technology and development and productivity actually create jobs for people. Now, what those are, we don't know. Is there going to be possibly a dip and then a change? Is there going to be a change within different industries? Of course there is. People have to reskill? Of course there is. But human needs in general are infinite. You ask somebody, 50 years ago, would there be a nail salon on every corner? Because we have so much extra money now because they're so much richer that people get their nails done every week. Nobody would have believed it. Or that we have gamers that are professional. A direct, quick example of AI right now is everyone assumed, and I think this happened just recently or has come out recently, but everyone assumed, for instance, that radiologists are done with AI. They are done, right? I mean, why do you need somebody to review something like that when you can have AI do it and do it more accurately? But what has actually happened is that AI has increased demand for radiologists because it's made them more efficient. In fact, they've actually now have AI augmented radiologist jobs where if you know AI and you're a radiologist, you're actually more in demand now. And so this increased speed to be able to review radiology reports and to review more complex reports has actually allowed radiologists to handle more cases per day, and then which has increased the capacity of medical institutions in general to offer imaging services. So, long story short, radiology actually has a higher demand for jobs now than it did when AI started, and it's because of the AI changes it's made to that that area, which was the prime example of something that would be destroyed. So I think when people jump to say we're done, jobs are done, everybody's just going to sit at home and have robots, I think that's a load of crap, honestly. And it's just that nobody can predict what the changes will be. And it will happen. But yes, it's going to cause changes in our industries, but we don't know what. And overall, there will be more jobs uh, 20 years from now than there are now. I can promise you that.
And I just to put that historical perspective, to hammer that home, since 1940, MIT says, yeah, they did like kind of a review of this, and I think something like 7 out of 10 jobs that we have today didn't exist in 1940.
That's right.
70% of the jobs. So obviously that's a whole human life cycle, right, of life. But, in 80 years, it's unlikely that any of the jobs that we're doing today are going to be the jobs that we're going to be done in 80 years. So we just have to be ready for that change and do our best to manage that complexity and that change management, as, certainly some industries are going to move to robotics or compute faster than others. So we'll just have to stay on the cutting edge. So with that, I want to thank everyone for joining us this week and for another episode of the Deal Flow podcast. If you'd like to reach out to us, our contact information individually and collectively will be in the show notes. So with that, thank you so much. We'll see you again next time on the Deal Flow podcast. Have a great day, and we will see you soon.